even in FOMC, the biggest event for a US dollar, we care about the numbers. And so we're going to dig into the numbers.
Cool.
But already seeing Forex volatility spiking on some US dollar fear. You've got euro dollar back close to 110. You've got even the commodity currencies starting to rally a little bit. Let's see what it means for a number of pairs, but especially this euro dollar. And I wanted to take a look at markets a way that we don't usually look at it, but you and I have looked at futures markets and equities markets and different markets in the past, and I think can lend to this Forex space. Volatility or fear spikes following large moves in actually either direction. In equities, you tend to see volatility only spike to the downside.
Right.
You don't see equities crash higher. But for example, here we have in blue the euro dollar price, and on the left side is the price there, and you can see the recent run from below 105 all the way up close to 110 on that blue line. And on the orange line, you have volatility, and you can see volatility spiking actually to 9.1%, which is the highest that we've seen in euro dollar vol for the last year plus of trading with this upside move. What's also interesting is if you go back a few months, the move in euro dollar from above 110 all the way down to 105 also saw a spike in vol up to 9.1%, which has been the high. And so right now, euro dollar volatility close to the highest that we've seen since October of last year, 9.1%, which is the highest that we've seen the last year. Plus, we're looking at realized volatility and the fact that it has moved higher in both directions. Like I say, equities don't tend to crash higher, but markets like this where you kind of see symmetry on both sides. You know, a 2% up day, a 2% down day is kind of equally as likely in Forex, whereas in equities, a 2% up day is probably less likely than a 2% down day.
It's right, the natural skill.
And I wanted to look at not only these realized volatilities, because they've gotten kind of elevated. I mean, we've seen plenty of years, Pete, where volatility in euro dollar, in sterling, in yen is 3%, 4%, 5%. All of them here in the majors above 6%. And in those commodity currencies, Aussie and Kiwi, close to 10% realized volatility. Now, what I also wanted to do was rank it. And when we rank volatility here, Pete, we're pitting the current volatility against the last year's worth of data to see, okay, that volatility number is nice, but what does 9.7% actually mean? Well, it actually means it's 81% rank, which is to say that it's very high in the range of volatility for the last year. You look at that euro dollar, Pete, of 8.8% volatility and an RV rank of 93%. That tells you that we're pretty much close to the highest levels, volatility levels of the year. Surprised by any of this data?
I'm surprised by the Kiwi and the Aussie, considering that they haven't motored as much. But I think I'm not to the extent that when the dollar moves, the commodity currencies, New Zealand and Aussie, tend to get more elastic.
The most volatile.
And so they are. And I think what it spoke to is that when vol was low in FX, Aussie and New Zealand Kiwi vol were always higher than euro or sterling. They actually went below it. So they really compressed. So this is showing a normalization of volatility a little bit by them getting back out to that. They have more whip to them.
But it's interesting because, they're not the most expensive.
No.
In the dollar sell-off, they haven't seen the biggest gains, but they have seen the biggest percentage back and forth. Now, here is the final piece, taking a look at how traders might use this data.
And this is it.
You can't say like, oh, well, okay, a 9.7% volatility in Kiwi, what does that mean for me? Well, it means right now at these relatively repressed prices that 35 points is really the range. And we use these because it is essentially telling you with 68% confidence, this is where the price has tend to settled on a day-by-day basis, on a net change basis. And so you would expect with 68% confidence that Kiwi would move 35 points in a given day, Aussie 37 points, euro dollar out to almost 60 points. Yen has been decently
6 months ago, that was 24 points.
So vol is up for sure. And as a last piece, just looking at the last couple of days, this is a 15-minute chart. If you want to say the start of day is midnight, you say the start of day is really whenever. You go by the net changes in the platform, it's totally fine. But you can see multiple occurrences of this euro dollar going from the start of the week 108.80 up to 109.25, right around that 1 standard deviation move, and not necessarily getting outside. Of course, it can get outside of it 32% of the time. It will. But you can see that that's a net change, a range that the market has tended to be comfortable with. And you can kind of measure, if I'm looking for big moves, I would start to look at them for euro dollar around 55 to 60 points. And so interesting little concept, get you ready for whatever events are coming up.
Right. And all those, if you want to buy a pullback because you think euro's going to 112, you've got a good level to think about. If you want to sell a blow off top, 55 to 60 points to the upside is great. If you want to be a little bit more conservative, because it's a binary event, you take that and multiply that by 1.5. You're less likely to get hit, but you've got a little bit more edge on that because you're moving closer to that 2 standard deviation or 95% time. What this does is it gives you a good construct of decision making around products that isn't like 50 pips in euro, Kiwi, Aussie, it's all the same. It's not. This is why we use
the great equalizer.
Statistics to equalize.
Yeah, absolutely.